Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, January 2nd, 2020. Welcome to the new year, everybody. I want to wish everybody a happy and healthy and prosperous new year. And what we're going to do in this video today is take a look at just a quick overview of the broad market longer term, and then go over the wanted to do the 11 sectors within the S&P 500. So going forward over the next week or so here, as we head into the new year, I want to highlight the most bullish and bearish sectors and asset classes. So what we're doing today is we're just looking at equities. That's one asset class. Bonds are another asset class. That's fixed income. Gold, commodities. Gold has its own niche in the precious metals, and you have various types of commodities. So you have all these different asset classes, and the key to investing or trading is to first of all, diversify. Don't have all your eggs in one basket. Build a portfolio, whether you're active trading or investing. Build a portfolio of of different asset classes, because they tend to have a very low, if any, correlation between all these various asset classes. And of course, stocks. Everyone wants to always know what the stock market's doing, so we're going to go into that in this video by looking at the indexes real quick, some long-term charts, and then we'll just take a look at the 11 sectors that make up the S&P 500. The S&P 500 is a more diversified index than the Nasdaq 100, but as I mentioned in the update this morning, the stock market is all about technology. Make no mistake about it. It's nearly half of the Nasdaq 100, and it's still the top-weighted index in the S&P 500 at nearly a quarter of the returns are attributed solely to the tech stocks. So let's start out here and just look at the big picture. This is a monthly time frame. If I don't make mention, I'll try to tell you what time frame we're on. It's usually up here in the upper left-hand corner, SPY monthly chart. So we go back all the way into the 80s here, late 80s, and you can see all the bull and bear markets over that period of time, and the similarities with most, but not all, but most bull markets end with divergence on the monthly chart. You can see the divergences marked down below on the RSI and the PPO here, and you can also see the trend indicator. So right now, it doesn't take a skilled technician to tell you that the overall trend is bullish. Markets up at or near all-time highs, so obviously that puts us in still in an uptrend. And the levels to watch, you can see, of course, the corrections and how much the scope of the bear markets in the past. In this big drop here, the S&P was only down about 15%, but you had the tech sector and many small caps, mid caps, they all dropped over 20%. So technically, they hit the bear market metric back there. Broad market just managed to skirt it. And then back here, we also dropped about 20%. So in some indexes, quite a bit more, some sectors. So there it is. Now, where we're at is, by all counts, even though you could say bear market if you drop 20% there, at least in quite a few sectors and other indexes. But the bigger picture is this appears to be just a correction within an ongoing bull market. The term that I've used for this bull market is supersized. Kind of like McDonald's, you go in order to supersize your meal, you get a giant quart of Coke, you get this, enough French fries to feed an army, and that's what this is. So by supersized, being that it's the longest and strongest bull market in history, you're going to have bigger rips and dips, or in other words, the corrections within there, measure what is the traditional metric for a bear market. That's a drop of 20% or more off the highs. So again, don't get tied up in whether you drop 20.01% or not. It's just really a correction so far within a bull market. Now, the levels to watch are pretty clear to me on SPY. I've gone over this chart quite a bit in the past, but I haven't touched on it recently. I can say without a doubt, the two of, if not the two most important levels on this chart to me, are the uptrend line. That's off the lows back on December 24th now the year before last. That was 2018 when the market bottomed out there. We have a pretty clean trend line that you can see on this monthly chart. Again, these are monthly candles, so that's 1 month of trading each candle. A well-defined wedge that's set up within the larger trend line. So what happened is we broke the bull market trend line, and what I'm referring to back here, here's a low. That was March 6, 2009 when the market bottomed, the S&P 500 and most indexes. And you can see we have a very, very well-defined trend line. And when you're drawing trend lines, I like to capture the most amount of bodies and or shadows, the skinny part on the candles. So you have numerous candles test to that level. And so what happened is back in the fall of 2018, we broke down and below that. We came in and we back tested it since then, and we've been back testing. And again, as I zoom in, and I'm referring to the yellow trend line here, that's the one that comes off the lows. So what happens, we've been back testing and it forms this wedge pattern here, defined by, of course, the primary trend line on the upside, and then the trend line off the lows on the 24th of 2018. So that would be our first sell signal, and what you have to look for. Unfortunately, in the monthly chart, they're not great for timing. They do paint the bigger picture. So what you need to see is a solid monthly close below. Doesn't matter what happens intra-month, because a lot of times you'll pierce that level only to rally back and close at the end of the month. So when you're trading on a monthly time frame, you need to wait to see how that candle closes. Now, should we be, let's say, well below that level, and we have 4 or 5 trading days left in the month, it's probably a safe bet you're going to get a close below. So that is one right there we'll watch for. And again, we're comfortably above it now. Although, like I'll go over here in a second, we still have the divergences, everything that was in place, and we're spanning decades here. All the other bull markets, right at the top, they look like this. But the problem with these divergences is they can and often do expand. They continue to grow. So they are not sell signals, as I often say, just merely indications you'll have a trend reversal as long as those divergences remain intact, whether they continue to build or not. And so that's the case right now. We had a divergent high back in that drop, that roughly 20% drop back in the fourth quarter of 2018. That divergence not only was it not negated or taken out, it's only expanded, indicating that finally when the turn comes, it'll probably be a much larger drop than that. And again, so you have the uptrend line there. And the other big thing to watch here on this chart is this 20-month period exponential moving average. So again, we're on a monthly chart. So this is a 20-period exponential moving average, and it has done just a phenomenal job of defining bullish and bearish trends. So really, that would be the nail in the coffin, because if this trend line is going to break first, if and when we finally get that sell signal, then the 20-month comes in after. And you can see here, bear market back there, we cut below it. And other than that, it just does a phenomenal job of acting as support during a bull market. And then once you break it, you're going to zoom in here and take a little bit closer look. Let's go back there. You can see back there we broke the trend line. And that's what I like about this chart. And this is usually what you'll see, is you have both a very well-defined uptrend line like you did back here in 2000. There's the dot-com bubble. You broke the trend line, and then shortly after you broke and back-tested that 20-period EMA. And even then, yes, you didn't get out at the top, but if you were long and you waited to see a monthly close below there, especially that 20-month, you still averted about a 43% drop out of a total 51% bear market. So that you were either short or out of your longs for the bulk of that bear market back then. And then you zoom in, you can see the same thing here. Look how perfect the trend line and the 40-month came in together. Big red candle right through there. Here, let's zoom in a little tighter. Solid red candle, that's what you want to see, impulsive. Then if you missed that, because that was a big, swift drop back in late 2007, guess what? You had a second chance. If you were long and regretted not getting out earlier, you had a chance to exit your longs there. And if you wanted to be short but you didn't catch it because that move down was too quick, you had a golden opportunity on the back test of that 20-month EMA. And from that point, out of the 57% drop, you still had you got 52% more downside. So in other words, you were able to again avert the bulk of that bear market by using these long-term trend indicators. So that's a great, for 401k accounts, IRAs, long-term investors, whether it's a retirement account or not. This is a good one to use. Now, as with all indicators, it's not perfect, and you can see here we sliced through it a little bit there. We came above it back there, and that's, once the bull market was underway, we came back in there. But most of these, you can see, if you had a close back below the 20-month, I'm sorry, since then, it was a marginal close, and in most cases, it was not followed up with an additional red candle. You regained it the next month. You see that green candle means we closed at the top of it. So again, a couple whipsaws here and there. But overall, a great job of defining the bull and bear trends, especially, that was right after the end of the previous bear market there. And again, you can see a few candles slicing through here, but a lot of those candles, or all of them, either closed just a hair below the 20-month or above. And again, as I mentioned, there was actually a bear market in several sectors and some other industries there. And that's it. So I just want to point that out. There's one little close below back in December of last year, but the following month we managed to close back above it, so we didn't have a confirming red candle. That's usually what you want to see to help seal the deal when you get a break of these longer term trend lines. So there it is. We'll watch that. Like I said, the divergence is still very much intact, not even close to being taken out. But divergence is not a sell signal. We had divergence there, and we got a correction out of it, and we just continue to diverge higher. So that's the long-term picture. I'll just touch on QQQ since I've already covered the same key points here. Here's our trend line. The Qs in the tech sector bottomed back in late 2008. Unlike everything else, just about every other sector and every other index bottomed in March of 2009. So here's a trend line. It starts off that 2008 bottom in QQQ, and it's very well defined. You can see here. You have a reaction there and that big drop. You have perfect candles here. You had a red candle there. You pierced it intramonth and closed right back above the trend line. You dipped below it intramonth there, but closed way above it back then. And you can see that 20-month EMA just doing a phenomenal job, in my opinion. Look at it capturing the bottom of all these candlestick bodies and or wicks right there. And so that's it. That's the magic number to me. And you can see, and this is, of course, the index that I put a higher weighting on, even though it's not as diversified as the S&P 500. And these come in perfectly right now together. Now, we're comfortably above it. Don't get me wrong. I'm not looking for any type of sell signal today. You've got to drop about over 12% just to get down to those trend lines. So this is something to watch going forward. Again, this is a first trading day of the year, so I'm getting these charts out there, painting the long-term picture. And now what we'll do is roll into the 11 sectors within the S&P 500. QQQ, it's not diversified enough to even bother with the sectors because, again, it's about almost half of the returns from QQQ come from the tech sector. And so we can look at XLK, but it's going to pretty much mirror. There's the same trend line off the 2008 lows. It's going to mirror QQQ because of so much overlap in there. So what we want to look at is the S&P 500 sector. Okay, so here's a watch list that I have, and it has there's 11 sectors within the S&P 500, and they're and I have these sorted by market. I'm sorry, not market cap. By the weightings in the sector. So XLK is a technology ETF. That is by far the largest. So we're going to start there, and as we go down the line, and I'll go over the weightings on each one. Keep in mind that you get down towards the bottom here, and it doesn't matter how bullish or how bearish these charts are. Their weightings are so small in these bottom components, about 3%, that they're not going to move the needle compared to XLK, which it's again the top weighted sector in the S&P 500 as well, nearly 0.25% of the returns. So these guys can rip or dip 10, 20, 30%, and they're not going to have nearly the impact that XLK would if it moves 10%. Okay, and since we're on XLK, again, it was a segue in from you're looking at the QQQ chart, almost mirrors it. Same trend line. Let's not beat a dead horse here. That's what we have to watch. You can see the 20-month EMA comes in a little bit higher. That'll come in first. Then you have this trend line here, and right now the trend is solidly intact. But in the near term, what you want to watch for here is that trend line again off the December 24th, 2018 lows. There it is. Again, you want to see the candlesticks. It's most important where they close the month, and you can see each and every time we have little intra-period breaches of that level to close back above it. And as you can see, we're wedging higher with the divergence still very much intact on the monthly chart. Now, what we'll do on each of these, we'll step down on the time frames, because a monthly chart is great for determining the long-term trend, but let's just say you're an active trader. Let's say you swing a pretty decent position size. Well, again, it's going to take 12+% to even get down to those trend lines on QQQ, and that would be a painful hold for someone that's long and giving back that much, and again, just to get to those trend lines. And then, of course, you still need the sell signals, going to be probably 20% or more from where we're at today, 20% drop or more, to say with a high degree of confidence that we've triggered those long-term sell signals and the fact that maybe the bull market's over. So we look at the daily chart. I have the same trend line really off the, that's the most important level to watch, off the December 24th, 2018 lows. And I have two. I have this one up top, which I think comes in well. And then this one is what I call my benefit of the doubt trend line, because I'm taking this trend line, starts on the same point. I'm catching the bodies of these four candles right there, plus the tail or shadow on that candle there. So that's my BOD trend line here. We'll do this. I might already have an alert, but I'll set one anyways. So when that breaks, that'll tell me, I'll get an alert that the weekly trend line is broke. And then what I'll do at that point, let's say it comes on a Tuesday, I'll wait until Friday to see how does it look. Do we have a solid close below there? And if so, we have a sell signal in XLK, which means we have a sell signal in the market. As of now, like I said, I have not a single thing in this chart that says that the trend is over or even in jeopardy. We have divergences, but those can continue to build or even be taken out. What we'll be on watch for things like a bearish engulfing candlestick, like we had back there, like we had right there. There's a bearish engulfing, and that was the top right there back in 2018. That led to a 25% drop in the tech sector right there. So those are some of the things we'll look for: candlestick reversal patterns and/or trend line breaks and breaks of key moving averages, like the 200-day. On this weekly chart, it's a 40-week moving average. It's the same as a 200-day average on a daily chart, because there are 5 calendar days in a week. So if you multiply 5 times 40, you get 200. And so I watch this level. It does a great job of defining the intermediate term trends. You can see, go back in time, this was whippy period here, but other than that, roll back and look at the bull and bear markets, and it usually does a really good job of defining the major trends there. So that's something to watch here on this weekly chart, and then of course that other trend line. And we zoom down to the daily chart, and you can see it's been the same story on XLK. Divergent high, just a series of these divergent highs on the corrections, and once in a while you get a divergent low. But in a bullish trend, you can look for these divergent highs and then sell signals, such as right here we had back then, break of the trend line right there, this wedge pattern right here. That was your trend line, and that started that correction that took us down 25% off the highs. And the next time we had a divergent high on the daily time frame here, 12% drop. We had another one there. And again, it's not just a divergent high, it's these trend line breaks right here. And we had one here, although at that point, did we have? Yeah, we had divergence, but what happened? We broke down and we've been back testing since. So that has set up XLK in this channel, and I'm spending a little more time here on XLK than I'll spend on the rest of the sectors, only because, again, the importance. No reason to spend 5-10 minutes talking about utilities unless you're trading the utility sector, because they're not going to move the needle that much. So there it is. Here's our breakdown. Been back testing very strong today. This is the bulk of the gains in the market are attributed to XLK, as I highlighted this morning, to the tech sector. We need to see a break of this to trigger anything close to a sell signal, or of course candlestick reversal pattern. There's the weightings. I updated these today. 23.2% weighting in the S&P 500. Okay, now moving on to the rest of them. XLV. And what I want to do too is, being the start of the year, go over the sectors that I think are the most bullish and the most bearish. I might not have a strong opinion on some of these sectors, but I can tell you this one right now is one of the more bearish looking sectors within the market. XLK is strong when the turn comes, because it's a very top heavy crowded trade. There's going to probably be a sizable drop. We just don't have that sell signals yet. XLV has broken down. Now keep in mind, as I go through, if I highlight a sector that might look more bearish, or even one like this that's recently broken down, it's probably only going to drop so much if the broad market continues to rally, because an index is simply a sum of its parts, and as long as money is flowing into the index funds, into SPY and the various S&P 500 funds, they are buying prorated. The money is being spread out among all the various stocks and sectors in there. So with a 14.2% weighting in the S&P 500, if you have a lot of cash inflows into the index funds, well, they have to buy these stocks. That doesn't mean they can't go down. I have seen many times, and you will continue to see, certain sectors correcting within bull markets, and you'll see certain sectors rallying within bear markets, and bucking the trend. But again, it puts the wind at its back, wind to the sails. If you are shorting, let's say, XLV, and the broad market is in a downtrend as well, you are much more likely to hit your price targets, or deeper price targets, than you would when the overall trend is bullish. But if I look at this chart in a vacuum, that's a pretty clean breakdown. There's a nice clean bearish rising wedge pattern. You can see there. You can see the divergences down below, and a very well-defined uptrend line. We broke down last week, and so far we've traded well below that trend line now. Anything is possible. Could we backtest? Sure. The trend is too strong. I want to see tech break. I'm not going to add this as a short trade, nor am I shorting it personally, but I will tell you right now, if you're looking to position for the year, this right now, at least in the foreseeable future, is one of the more bearish sectors. And by the way, it is the second largest sector in the S&P 500 at a 14.2% weighting. So that I believe will give a headwind, if you will, somewhat of a headwind to the S&P 500. Here's what it looks like on a weekly chart. You can see all the divergences. Pretty much the same trend line. Very clean up trend line right there. All these weekly candles, just about all of those, most of those I should say, touch that the trend line, and then so far a solid break below. Now this week is not over. When I think I said last week, I should have said that is Monday right there and Tuesday. So this breakdown occurred this week, and we'll see how this weekly candle closes. Solid red close below would be a sell signal, and especially if we get follow through an additional red candle next week, you want to see these PPO start to roll over, RSI turning down off overbought levels. So there is, again, I think one of the more bearish looking sectors right now in the market. All right, let's move on to next one. We'll go a little quicker through these again in order. Let me go back to the daily chart. I'll show you what the weighting is. 12.96. So here's the third largest sector in the S&P 500. These are financials at about a 13% weighting. You can scroll back here in time, see all the divergent highs that we've had in the past, and what the corrections, I think, on some of these. Well, I didn't measure it out, but you can see them visually, divergent highs, and look, of course, for the sell signals, trend line breaks, and then of course divergent lows are time to get long. Divergent high, correction, divergent high, correction, and we have a divergent high plus a pretty clean trend line to watch. So here's a pattern if you want to replicate it. I have a trend line coming off the October lows here in XLF. Again, the financials, that's the October 3rd trend line, and there's our divergence line right there. We put in a divergent high. Any new high will still be a divergent high. Remember, when you're working your way up within a wedge pattern, you can continue to work up, and that divergence line may need to be moved if we go a little higher, but as of now, this is what it looks like. So we could do this, we could do that. Who knows? Maybe we take out these divergences and there are no more divergences in a couple weeks. But as of now, there are, and so you want to watch that level. And let's look at the weekly chart on XLF. Yeah, that's what we did. Okay, so XLF is just broken out to new highs. Unlike the market, there are quite a few sectors that are still not above or have just barely taken it out, like XLF. You can see I'm referring back to the February 2018 highs. We broke out, and so far it's been a pretty unimpulsive breakout. Very little follow through. The volume's been pretty low, but again, it's the holiday. Last few weeks we've had the holiday season. We had Thanksgiving back here, Christmas here, New Year's this week. And so you want to take all these breakouts with a grain of salt. So as of now, there's a breakout. It's above 30.45. Price comes first. Volume is a distant second, in my opinion, but it is a second. So we're not really confirmed right now. No follow through, but we'll watch this one. And should it reverse, then maybe a back test at this level right here. We had a breakout there. I don't have a very strong opinion on XLF, so I'm going to say right now, let's just say somewhat neutral on that one. XLC, this is a communication sector, hasn't been around much. This is the old telecom sector. They collapsed the telecom sector. That was one of the 11 sectors within the S&P 500 last year, and they replaced it with, or in 2018, I should say, I believe it was. No, it was last year. Yeah, 2018. There it is, 2018 right here. It started trading. They replaced the telecom sector with communication services. So a lot of those same stocks. And you can see here we broke down. We had a trend line break right there, and we've been back testing it from below. Not a lot on these indicators. And, they're in bullish territory right now. They're up there. PPO is rolling down. One to watch. We could probably put a minor trend line below there, maybe even take that one down. Yeah, I think we can do that. Let's do this. Let's add that and say that's our benefit of the doubt or secondary trend line. So you might want to set an alert if that breaks. And look, if the market has a lot of room to run in 2018, here's what you would want to look for. This is a very, very good support level, 51.72. You had numerous reactions there on or around that level since XLC came out. And so it was consolidating here within this range and tapped on it, finally broke out. Wasn't a very impulsive breakout, but we back tested it successfully and then moved on. So that would be an ideal, an objective place to buy. Doesn't guarantee it'll play out, but if you go long there, if we do get a pullback soon, you set your stop somewhat below. Because if we go much lower, you'll probably come all the way back to the bottom of this trading range right here. So there's XLC. Probably not worth really looking at the weekly chart because we don't have enough trading history here. It's the same trend lines I have right there as on the daily chart. So let's just move on there. And that's, by the way, about an 11% weighting. XLY, this is a consumer discretionary ETF. And you have also about a 10% weighting in the S&P 500. Here's a trend line to watch right there. This is a daily chart. You can see we continue to diverge just as we did here. And usually after you've been diverging for a while, moving up, that's when people lose faith, saying, oh, okay, well, divergences don't work, the market doesn't work. And as I say, they're not 100% effective, but they can span for months, sometimes even years. In this case, these divergences lasted all the way from January until finally playing out in late September, I think is when the top came there. And again, the divergence itself wasn't a sell signal, but what was this break of this wedge right here, the trend line. And from there, the consumer discretionary sector, once the breakdown occurred, fell about 21%. And it did so in 2.1 months, just over 2 months. So you wiped out a year or more of gains right there in just a couple months, and that tends to be what happens. So this is the same story. We've been diverging now really since this point right here, since this high. You had a correction at that point, pushed up, made divergence. You had a correction from there. That was our first divergent high. Let me show you what I'm talking about here. You had there's divergence line. Let me grab my line tool. Divergence right there, and a pretty healthy drop. And we pushed on up, fell just a little shy of that. Now we've actually taken out that previous high marginally. That's the theme here. It's not seeing very impulsive buying on a lot of these that have taken out the previous highs, just like financials, like I just showed you. And what it's done is extended the divergence. You could probably put a minor trend line here if you want to watch that. That might show up better on a 60-minute chart. You might want to replicate that. We're still in a daily time frame. So watch break of that to bring us down to this trend line, maybe get one more reaction. Either way, a break of that trend line would be a sell signal. Let me set an alert there too. There we go. All right. And on the weekly chart, here's what it looks like. These are the divergent highs that we've had in the past. 11% drop, 18%, 17, 22% drop into the 2018 lows, and we have another, divergent high. We're still moving up. So we don't have any sell signals, and maybe it'll continue to diverge for a while, maybe not. Maybe the divergences will be burned through, maybe not, meaning that the indicators come out and take up those previous highs. But we are looking at multi-year divergences right there, spanning almost 2 years now, and that's typical what you see, heading into the end of a bull market. Back here I can draw the similar divergence lines, or about equal highs there on the RSI, slightly lower high on the PPO right there, leading into the 2007 highs. It might not look like much when you go back, on here. If we take a zoom in, you can see there, that's what it looks like. And you can see when those divergences, they took years to build. When they finally played out, bigger the divergences, usually the bigger the drop. That was about a 60% drop in XLY back then. And next up, we have industrials at a 9% weighting, 9.05. We've pretty much flattened out here. We do have, I should note it here, we have divergence building right now. It's unconfirmed. We need to turn those indicators down. And look, we can certainly extend this, and this maybe forms into a wedge, does something like this. Whether it does or not, we have a minor trend line. I don't want to put a lot of stock in this trend line because there's only a couple reactions, but it's just a potential scenario. Should we, let's say, start to get a few more reactions, we could wedge up and then get a breakdown. Like I said, no reason to be short right now. We don't have any sell signals, but these are levels to watch. And again, there's a lot of hot air built up in this market, and what happens is people become complacent. People think it'll go up forever, and all of a sudden you get a sell signal, and if you're not quick and you're long, you're going to lose a lot of profits in very short order. If you were long back here and you didn't heed that sell signal and you said, oh, well, everything, the economy's in good shape, you dropped 24%. Now, what does that mean? Well, you also wiped out gains going back all the way for last over 2 years of gains were wiped out here after that drop, and just from the highs right there down to the lows was about, oh no, I gotta go right here. So if I'm measuring in time, that from the highs to lows, 3 months. And that wiped out again 2 years of gains right there. So those are things you have to watch out for. That's why I do these videos in advance. And when we look at the weekly chart, XLI, again, these are the industrials. You can see here's our bull market uptrend line. This looks similar to the S&P 500. You have the uptrend line right there. Like the S&P 500, it broke down back then, but we haven't even back tested yet, and we've set up within this little wedge below the primary bull market uptrend line right there. The divergence is still very much intact. We had divergence at that high back in 2018 before that 5 or so percent drop. We got oversold at the lows and we bounced, but we've extended the divergences. And I want to say this too, guys. And what I'll be doing over the next couple weeks here is digging down. We're right now, again, we're focusing only on the equity market, the stock market. And as I like to say, the stock market is simply a sum of its parts. Now, those parts aren't equally weighted. That's why we've spent a lot of time on XLK, the tech sector. But we'll look at these. This is still an important sector in the economy. And within XLI. So within the industrials, what I do, I like to use a top-down approach. That means we started out with the indexes themselves, and I started out on the long-term time frames, a monthly chart. We looked at the weekly charts, and we've gone down to the daily charts. Within XLI, for example, I can drill down even further. Here's the information on the XLI, the industrials ETF. So what I note is, okay, well, what drives XLI? I can look at the chart all day long, but if I want to get a little more insight, then I drill down into the industry allocation. So these are the subsectors, if you will, within the industrials, and I can see here from their website that 27%, and it's represented by the size of these boxes. The bulk of the XLI is represented by the aerospace and defense sector. So then what I do at that point is, if I want to get a heads up, let's say I'm getting ready to make a trade on that, I'll take a look at the defense stocks. I'll go to ITA, which is the defense sector ETF, and I can see here on a weekly chart, okay, well, this is going to give me a heads up. Here's a pretty nice price channel that didn't show through on XLI, but I can see a pretty clean price channel on this weekly chart, and I see that 200-day moving average that often acts as a key support level. It's the red line here, and it comes in perfectly with the trend line. See, we broke it right here, right there, break, back test, boom. Held it here, support, 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 support. Kind of chopped through it there. We were in a correction mode back then, bear market mode actually. This sector dropped over 20%, so we went below. We were in a bear market. So again, it's done a great job at finding support and resistance. So where I'm going with this is I will have a good sell signal, a pretty high probability sell signal, if and when I get a solid break and weekly close down below this trend line as well as that 40-week, and they come in together. So if I get one, I'm going to have both if it happens anytime soon. And then that will give me a heads up. Let's just say at that point that XLI hasn't yet broken down, or I don't see a clear trend line or reason to short XLI, but based on this telling me that this is one of the top components of XLI, that would give me confidence that XLI is going to drop, in which case it's going to put pressure on the broad market. So that's sort of a top-down approach. And I can even drill down further, and by going to the site here and saying, okay, well, I know that aerospace and defense is the biggest sector. So what is the biggest stock within there? And I go up here, top holdings, Boeing, at about 7.18, by far the largest component. So then I go here to Boeing, and I take a look at this chart. Now Boeing, since back here I started pointing out this ascending broadening wedge, giving you two price targets, 322, 42, and 150. We went on to finally break this trend line here, and I've had some inquiries on Boeing lately. Market's holding up, so Boeing's holding up, but right here you have, this is a large wedge pattern. You had a divergent high, the wedge broke down here. We've been backtesting, holding on that key 322 support. Again, that level was laid out in advance before the breakdown. We've been bouncing off it. That further validates that. It was a good support level back here. We had a little trip, during that meltdown in late 2018. We sliced below it briefly, but then regained it. It is still a very important level. So what I see is if and when this breaks, and I believe it will, but it hasn't yet, we'll have a pretty powerful sell signal that's going to bring me down here to my bear market target in Boeing, and that is a drop of about, and it won't happen overnight, but that's where we go, 52%. That will have a significant impact on the aerospace and defense sector, which in turn will have a significant impact on the industrials, which in turn will have an impact on the S&P 500. So that's what I'm talking about, a top-down approach. What would make Boeing look a little more bullish? Well, obviously, yeah, as I like to say, support is support until unless broken. So if it holds 322, great. If you're a bull and you think the market, especially the stock, is going much higher, I can tell you right now, this is a very objective level to step in and buy. If you like Boeing, you like it for the dividend, you like it for the capital appreciation, you can step in and buy with a stop somewhat below, because that's objective. You're buying at support. I can't promise whether that support will hold or not, but I can tell you, I can promise it's objective to buy at support with a stop somewhat below. Give it a little room, give it a weekly close at least, and you could target at minimum that 385 level right there. You can see it's this trading range, pretty much where the stock has traded for years now, within that range, other than this brief pop above, a little false breakout there, and the brief pop below. That's all the trading has occurred within that range. So this is TA 101, or trading 101. You buy support. When you're in a trading range, you buy at there, and you hold and go long up to the top of the trading range or just below it, and then you turn around and you close your long position. You can reverse short as long as that happens. It's not going to last forever. Sooner or later you get a breakout, and that's the other rule in trading there. When you finally get a definitive impulsive breakout above the range, that's most likely going to determine your next trend. So there's the outlook for Boeing. And again, the bigger picture, as I'm doing this video, well, if that plays out, it only stands to reason, chances are, as birds of feather flock together, ITA will probably continue higher, and therefore, the market will most likely continue higher as well. There's other components in there. UTX, I'm not going to get off task here. We're going to stick to the sectors for now, and but know this, that I'll be going through, as I do these videos, I look at the most bullish and the most bearish sectors, then I drill down into the subcomponents or sub-industries within that sector, and then I look at the most bullish and bearish stocks. That's how I come up with a lot of the trade ideas. All right, guys, we'll just run through the rest of these quick. We start going down now where they don't have much of an impact. Here's XLP, Consumer Staples, 7.2%. Consumer Staples is actually breaking down. This is a daily chart, breaking down today. Potential sell signal there. We have divergences, or had them at the highs recently. breakdown. Let's see if we get a solid close today. This is down 9/10 of, almost 0.95, almost 1%, while a lot of other things are up. Again, you can see the sector watch list. As I said today, it is almost all tech driving this market today. Yes, you see, the only other sector that's up 1% is XLI, and as I just went over, that's only a 9% weighting, which dwarfs, the XLK. All right, so XLP, potential sell signal, probably give it the benefit of the doubt. The market's healthy. I can tell you I'm not going to short this one. It's the first trading day of the year. I'm going to wait and see what happens the first, today and tomorrow, and probably pick things up. I'll probably get back into trading next week. But that's that. Well, and you can see some support levels here. I need to tighten up that line right there. There's a first two potential targets if that sell signal is confirmed with a solid close today. And bigger picture on it. Here's a weekly trend line, and you can see, and this is why I like to use both charts. So we're really come down, although we broke it on the daily, we're right at that weekly trend line support. So you want to see a little more downside really to have a decent confidence on a short on XLP, I think. All right, next up would be XLE. But with that being said, based on the posture, let me just loop back to it. Yeah, one of the more bearish. It's not a lot of these are defensive issues stocks, so they're not going to drop too much. If tech continues to rally, that's why this is selling off today. This is almost the opposite of tech. Tech rallies on strong economic growth expectations, and staples are the opposite. This is where people flock during times of recession, bear markets. They tend to staples tend to hold up because, as the name implies, these are staples, things you and I need, toothpaste, stuff like that, deodorant, consumer staples, things that we buy whether or not we're in a recession. You're still going to buy them, whereas technology, that goes down, and discretionary spending, consumer discretionary, those things tend to drop. XLE continues to be the energy sector, one of my, by far, like I said recently, without a close second, the most bullish looking sector, or at least the best risk reward, I should say. XLK is bullish because it just keeps going up and up and up. I can't make a case to step in and buy it. I can't make a case to short it either. But on XLE, like I told you guys recently, we had a trend line here. Set a break below there, and we'd probably get it because of the breakdown in crude. We got it, and then I said, I believe I mentioned that you can buy a pullback to the trend line. So far, that's textbook technical analysis right there. We had a breakout right here, break of the trend line. We rallied up. Crude put in some divergences on the 60-minute chart. We had a trend line there. We broke down below it with an impulsive gap, made a perfect test of the trend line, and so far, from there we bounced. I try to grab it with the crosshairs. Measure about a 2% bounce so far. At this point, we'll probably add a trend line right here, an uptrend line to watch, and so far so good. Let's look at the longer term outlook for XLE. Again, beat down, certainly in a bear market. We talk about the stock market being at new highs all the time. Not the energy sector. It peaked all the way back in 2014. This has been in a bear market since, and we're much closer to the lows than we are that high back in 2014. So, I think more potential. The story is this: if the economy continues to grow in 2020, at least let's just talk about the first quarter. It's hard to see out much farther than that. If we have another few quarters of growth, then crude oil should go up, and XLE looks good up here to that first target there, about 65.13. And if we continue on throughout the year, maybe 75.50. There's a next target up there. There are those other subsectors that I like, but we're not going to go off task here. The subsectors of the energy sector being XOP and XES, equipment and services, and then exploration and production ETFs. But let's just focus on these. This is what's represented here in the S&P 500, mostly the XLE, the components of XLE. And again, that was, if I didn't mention it, only a 4% weighting now, 4.35. It used to be much larger. XLU hardly moves the needle at 3.31%, divergent high right here. We had a correction and we pushed back up to that level. So effectively another divergent high. Even if they pop it, make a marginal new high over 65, it will still be a divergent high. So this one is looking more bearish, and I think that's going to be a reflection of, you know, higher interest rates in 2020, and utilities are rate sensitive stocks. Sell signal would come. You can either short it there with a stop above or a break below that level. You can see the first target there, second target. Let's move on to XLRE REITs. Not a lot that stands out. This is the most important level right here. This line forms a sort of an ascending broadening wedge pattern. We broke down, back tested right here, and we've been bouncing around this just under that 3850-ish resistance level there. We did have a small divergent low recently, but that comes off a very big divergent high, which I'd put a higher weighting into. So REITs might face some headwinds. They're also rate sensitive, so if, you know, rates continue to rise, as I think they probably will in 2020, then that would not bode well for the REITs. And then finally, basic materials, 2.66% weighting. There's an uptrend line to watch and a small little divergent high right there. No sell signals yet, but you can replicate this, set an alert under this trend line. And if you trade ETFs and you like the inverse, SDP I think is, yeah, the ultra short. Oh, that's the ultra short utilities. There's one for basic materials. It's not coming to mind right now. I believe there's a ultra short for that. But again, this one's utilities here. All right, guys, long video. I wanted to cover it all. Again, it's kind of what to look for in the stock market, and I'll follow up with other videos, commodities, precious metals, things like that, and then I'll drill down, as I said, within the sectors and subsectors and start sniffing out the most bullish and bearish setups and get them out to you guys. This has been Randy Finney with Right Side of the Chart. Again, Happy New Year.